Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and today I'm excited to have my XYPN co-founder, Michael Kitces, on the show today to co-host a mailbag episode focused on the theme of leveraging a TAMP. We launched XY Investment Solutions back in August of 2017, which is a TAMP for XYPN members, and have gotten a steady stream of questions regarding XYIS and just TAMPs in general. Today, we covered 4 questions that we get pretty regularly, including how to get past the hurdle of not being the one actually implementing the investment plan and explaining that to your client, why someone would want to use a TAMP in the first place, and how to explain and sell TAMP services to your clients. We closed out with the discussion of how to charge TAMP fees and if you should pass the fee through to your client or pay it out of your existing fee, as well as if you should even show the 2 fees separately on your client invoice. If you're considering outsourcing your investments, then this episode is definitely for you. Support for today's episode comes from Ruby Receptionist, the only live remote receptionist service dedicated to helping financial service professionals win more clients and build trust. From their studio in Portland, Oregon, Ruby's friendly professional receptionists ensure exceptional client experiences by answering calls live in English or Spanish, transferring calls, taking messages, addressing common problems, collecting new client intake, making follow-up calls, and more, just like an in-house receptionist, but at a fraction of the cost. Let Ruby help you turn your rings into relationships. For a special offer, visit callruby.com/XYPN and use promo code XYPN or call 1-844-853-7829. You can find any of the additional resources that we mentioned during the episode at XYPlanningNetwork.com/136. Also, be sure to go to XYPlanningNetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's XYPlanningNetwork.com/VIP. Without further ado, here is my mailbag episode with Kitces. Hey, Michael, welcome back to the show, man. Thanks so much for being on.
Thank you. Good to be here. I'm psyched to be back.
Yeah, and I'm excited because this is a topic we have been talking about hosting a mailbag episode on since we launched XY Investment Solutions last August at our conference in Dallas. So we did the launch and we started getting all of these great questions around, just overall sort of understanding and practice management around how to use a TAMP or an outsourced management platform. And so we've been sort of tossing around that we needed to do this. And so I had posted in our VIP group any additional questions in addition to the ones that you and I knew needed to be answered. And we got some additional really great questions. So today's theme, if you will, is all about outsourced investment management platforms and some of the very common questions that we get in related to both XYIS as well as other TAMPs that are out there. Which begs the question, we need to start by saying, what in the heck is a TAMP?
What is a TAMP? So you first just the acronym itself. TAMP is short for Turnkey Asset Management Program. These originally came about in the late 1980s, early 1990s was when they originally got going. And the idea of a TAMP, as the name sort of implies, is you have a third-party investment manager that gives you essentially a turnkey platform with all the things you need to do investment management. So that typically includes not only just the investment kind of research stuff itself and managing the portfolio, but typically it's got a back office service layer as well. So helping to support on just account opening and facilitating trading and supporting billing and reporting, either, in the past, rather manually, these days more and more with technology. But the idea of it is, when you want to manage portfolios, but you don't necessarily want to do the granular manual work of managing a portfolio by hand yourself, you can outsource this function to a turnkey asset management program. By its nature is turnkey enough that it's pretty easy to outsource it and do it and get it done so clients are well served, and you can move on to all the other things that you want to do, which frankly in the past was a lot of, well, I'm going to outsource my investment management so I can go get more assets. These days, it's more like I'm going to outsource my investment management so I can focus more on the financial planning.
Yeah, and for many of us that grew up in the world of financial planning, and we can talk about sort of who uses TAMPs, but I was definitely one of them because I didn't really know the investments as well as I felt like I needed to. But we see this basically if you're breaking away from a broker dealer, you've essentially been using a TAMP, even though they don't call it a TAMP. And just because the structure of the firm, you weren't able to just go and do all your own stuff. You were sort of still using this outsourced platform, which I felt the P in TAMP was platform. Apparently it's program.
I guess it's sort of interchangeable. There are people who do it either way. Frankly, when you go direct to them, it feels more like a platform. In the days when they were primarily distributed through broker dealers, which is mostly where they started. It was early companies like PMC and Brinker and Lockwood and SEI. Those were mostly companies that were active in the broker-dealer marketplace in the first place. So broker-dealers kind of like to think of themselves as the platform. So there's probably a little of like, no, you're not a turnkey asset management platform. You're a turnkey asset management program on our platform. Now in the RA world, we can go direct. So I'm like, well, I don't need a program. I need a whole platform. So the TAMP said, oh no, RP is for platform now. You can be everything with us. So a little bit just kind of a channel difference and a label difference. And the fact that TAMPs as programs through broker dealers kind of blended a little bit more on top of some existing broker dealer technology that's been in place for a number of years. Over time, as TAMPs really kind of grew into full-scale platforms of their own with all their own technology and all their own capabilities, they become a little bit less program and a little bit more platform.
And I think it's also fair to maybe give a quick background on why we launched a TAMP, because again, that sort of led to a lot of these questions that we're hearing. But as I mentioned, we launched XY Investment Solutions back in August, which is a TAMP exclusively for members of the XY Planning Network. So it's only available to our members. The director is Brandon Moss, who joined our team in September. That name may ring a bell for some folks. He spent about a decade of his career at United Capital and came over in September to take on sort of ownership of the TAMP and growing that. But, people, and we get a lot of questions around this, like, why launch another TAMP? And it's kind of interesting because the TAMP landscape is big. There are a lot of players. There's a lot of diversity and of different types of platforms that are out there. But it was a real challenge for us to find a TAMP that we felt was ideal for XY Planning Network members, because you have the programs like the BAM, Buckingham Asset Management. They're in St. Louis. I mean, they're gigantic, that are DFA TAMP and growing like crazy. I mean, there's Betterment could be considered a TAMP, and there's everything in between. Like those are like probably the two polar opposites of the TAMP world. And yet we really didn't find something that fit, that was tech heavy, but service heavy. Like I don't know, the TAMP world seems to be very service heavy, and behind on the technology, or it's tech first and really no service layer.
As well as just the challenge that historically TAMPs were kind of more focused on the asset management capabilities and who had a great investment management process, which tends to get sold to more affluent investors. And not a lot of TAMPs have any idea what to do with, well, my client really needs to open their $5,000 IRA contribution. What have you got? Or they're 28 years old and they're rolling over a $28,000 401k balance, which actually, if you're 28, is pretty badass, awesome 401k balance. But they're like, awesome. So when you have 10 more of those, you can meet our account minimums. So we were also just having trouble finding TAMP platforms that were built to effectively handle small accounts and weren't going to just chew them up in transaction costs, or outright just say, we won't work with you because your account is too small, or even we won't work with you because your advisors are too small. It's not uncommon at a lot of TAMP platforms to see $5 million, $10 million, even $20 million AUM minimums, particularly if you're an independent and not getting a kind of a group purchase through a broker dealer. And we have a lot of XY Planning Networks members that, because of their focus on working with younger clientele, like even if you've got a pretty, call it like a sizable practice and you got 50 or 75 or 100 clients, you still might only have a couple $1 million cumulatively under management because not all of them have assets, and some of them have assets, but still in their 401k. And you're not going to be managing that for a long time because they're still working there. And so we were just hearing real challenges from members that they wanted to outsource their investment management, but they couldn't work with most TAMPs that are available. Either it was too costly, the TAMP couldn't work with small account sizes, or the mere $3 or $5 or $7 or $10 million they had wasn't even enough to get onto a lot of TAMP platforms.
And quite frankly, they have a different niche. They just have a different focus. Most TAMPs are built to serve retirees or pre-retirees. And then in that distribution phase, I was not aware of, and I'm still not aware of any other TAMP that was built specifically for clients in their 20s, 30s, and 40s that are accumulating assets that may have a lot of various accounts underneath one roof, but which means it has to be digital first, obviously, and it has to have a lot of technology, but it also, you still need that service layer, which we're gonna chat about, some of the various things TAMPs do. But that was sort of what spawned the launch of XY Investment Solutions. And again, just to provide our members with a platform that was really built for them, instead of trying to take someone else's and basically hack it up, and try to force it to be, what would become the ideal for our members.
Yeah. Well, and no offense to a number of TAMPs out there that we did talk to. I mean, truly, like we kicked a lot of tires and talked to a lot of providers before we ultimately decided to launch our own. But it really did just come down to that issue of, we couldn't find platforms that we thought did a good job on the balance between technology and service, the ability to handle small accounts, an investment process and philosophy that we were comfortable with. Because, again, like, not even to get fully into the active versus passive discussion, but particularly in the context of like someone saving their first IRA contributions or doing rollovers of tens of thousands or even a few $100,000, like just the mathematical reality. Be your super awesome active management self. It's just really not material to add 100 basis points of return to someone with $20,000. It just doesn't, the dollars just don't add up to much. It doesn't have much impact. Even if you can produce that kind of value and any level of transaction cost grinding quickly chews you up. If you got $1 million, no one blinks twice at $4 and $6 and $8 trades on ETFs. But when you're putting in a couple $1,000s at a time, those transaction costs will quickly chew up all your returns. So, we also just wanted to find something that, wasn't about an active management process, but would just get a good quality portfolio in place, oversee it prudently, have the technology to do what technology does well, the service to jump in when the service needs to be there, and not be incredibly expensive, which, we did find a few platforms that would otherwise do this, but the costs were just very high. Yeah. We were hearing price like, sure, we do that for you. Our pricing starts at 75 basis points. And it was just too high for what we were comfortable with.
So I will ask the first question, which is, and they actually say in here, it's not really a question, but sort of sparks the idea to chat about it. So the comment here is, I worked in a firm that had a person working on investments as his sole job title. I always felt a disconnect between that and my clients. So he would trade and I'd have to explain what, where, and why, even if he told me. I have held back from moving to a TAMP because I feel like my clients look at me at the end of the day, even if I say someone else is doing it. Not sure if this makes sense. It's not really a question, but maybe you can speak to the idea of getting over that mental hurdle. This was my life. I mean, at both firms that I worked at, a total of 4 or 5 employees, we still had someone who was dedicated to investments. When I launched my own firm, I had never opened an account. I had never done a trade. I had never rebalanced. I was purely on the planning side, which is why I ultimately went with a TAMP, was because I didn't want to have to learn it. I didn't want to have to try to figure it out. In the midst of everything else that was going on with launching a firm, building out a planning process, building out the firm, building a marketing plan, the last thing I felt like I needed to do was design a rebalancing program and go research a bunch of ETFs. However, it's a valid question of, am I not the expert? And to sort of add to this question, I do hear sometimes, well, you should be the expert. And that sort of, it's going to go into one of our next questions, but like, you shouldn't be making recommendations and managing investments if you're not enough of an expert to do it yourself. So how do you get over the mental hurdle of, if my client's looking to me, I need to have an answer, and I don't want to have to say, I don't know, XY Investment Solutions or other TAMP, was doing the trading. I'm not really sure why they did.
So I think there's a few things that go with this. And I certainly understand the concern. Frankly, it's an issue out there, not only with TAMPs, but and outsourcing investments, but it's an issue even in firms that insource the investments once you grow to the size where you have the divisions of labor that start cropping up. So, we do a version of this for my own advisory firm that's separate from XYPN Network, which is called Pinnacle Advisory Group, where we manage $1.9 billion, give or take a little. And we have long since made this separation in our own firm. So there's a dedicated investment team that is responsible for actually overseeing and focusing on the portfolios and what we own and doing the due diligence and all the investments and so forth. And then we have upwards of a dozen financial planners whose responsibility is doing the financial planning and relationship management with clients. But what that means is the financial planners don't do the portfolio design, because the investment team does the portfolio design, the financial planners do the planning. But the client has a person that they talk to, which is their financial planner. And so, yeah, absolutely. Like if you're the relationship manager and the face of the relationship to the client, absolutely, it's true. The client's going to bring their questions to you. But how you handle this, frankly, is you need to be up to speed on what's going on in the portfolio. And I do think that's valid and relevant, that you need to be up to speed about what's going on in the portfolio. So for firms like ours, even internally, we have regular internal communications. We have regular firm meetings between the investment team and the financial planners, so that everybody is up to speed on what's going on with the client portfolios and how they're being managed and why certain decisions are being made. Now, one of the things that you'll quickly notice when you go down this road is if your investment approach is less active and more passive, there's not as much to stay up to speed on. Even aside from just the dynamics of, if I hire an investment team or another 3 CFAs or another 10 CFAs or whatever your firm's perspective is, can we get a little bit more return for the clients? Just the kind of the simple conversational reality, more passively oriented portfolios, once you kind of up to speed on the strategy and how it works, there's not a lot to talk about because it doesn't change that much. And that's part of what makes it a little bit easier to handle those situations. And I think is one of the reasons why you often see planning-oriented advisors in particular, where investments isn't their focus, tend to start tilting towards more passively oriented investment strategies. If your primary value proposition is the portfolios and the investment management, you tend to be more active because it is the only value you have to sell. So you have to do it and do it well. And you tend to be a little more investment attuned to what's going on in the markets and the rest. So that's a comfortable conversation. The more planning oriented you are, and the more that's where you focus your conversation, the less your value proposition is around investments. Clients still have money. It needs to be invested. You want to make sure it gets to a prudent place. So you need to have some role in it, or you may want to have some role in it. But the simpler you keep your investment process, the less there is to manage, and the easier it is to keep up on it. And so, even in the context of platforms like XY Investment Solutions and outsourcing to TAMPs in general, all TAMPs still provide regular communications to all of their advisors. Here's what's going on in the portfolios. Here's an update of what's going on in the markets. Here's just some talking points, so you're up to speed with what's going on out there, so you can sound competent in front of your clients. And we'll be doing that for XYIS over time as well. But the more simple and straightforward you keep your investment process in the first place, the less burdensome you'll find that actually is. And that's part of why we deliberately created fairly passively oriented ETF strategies in XY Investment Solutions in the first place, so that you don't have to go out to your clients and explain, the 27 trades that happened this month and what the investment team's thinking was in all of them. Maybe there's a rebalancing trade. Maybe our chief investment officer did due diligence and said, hey, I think this ETF isn't tracking its index as well. I want to shift to this other one. So yeah, there may be a little bit of stuff that happens from time to time. Even passive portfolios don't always remain perfectly static, but there's just not as much going on, which makes it a lot easier to stay up to speed, which makes it a lot easier to answer these questions that come up from clients because there won't be as many of them and they'll be relatively straightforward to answer when you're not doing a whole bunch of active trading in the portfolio in the first place.
And I think this is one of those areas where you almost are afraid of the question and the question may never actually come. Because, depending on how you're selling your services, right? If you're, to your point, if you're very heavy investment management, then you need to have those answers. I mean, if you're selling, we can beat the market by 2%, you need to be able to explain how you're going to do that. If you're saying we're tracking the index and people say, well, why did you make this trade instead of this trade? Like, I think we need to refocus the conversation and we need to move the conversation away from individual trades that are happening with rebalancing and that sort of thing and sort of come back to, okay, basically come back to the planning, come back to what are your goals? Does it really matter? And not that they can't keep up with what's going on in their accounts. That's totally fine. But, I'm trying to think if I ever actually had a client ask me why I made a specific trade. And I was very aggressive about not working with investment focused people. I mean, I used to joke that if anyone ever asked about investments in the intro meeting, it just wasn't going to be a good fit. But it was kind of true because that was just who I was as an advisor. So I do feel like, it's sort of like, oh, well, I need to go get, super expensive performance reporting software and give them that because they expect it. And I'm just not sure that they do. I just think that's where we came from as an industry. But I'm not sure that our clients really expect that from us now.
No, it's true. And I mean, there are different types of clients that come to the table with different expectations. Clients that are more investment centric are going to ask you more investment questions, right? Kind of by their nature. As you just said, Alan, that may mean, if that's really what they want, maybe they're not a good client for you. Maybe they're a better fit to get referred out to someone that does a bunch of investment stuff because if that's really what they want and that's what they're seeking and that's not what you do, it's okay to say, hey, maybe I'm not a good fit for you. I'm really more focused on financial planning. It sounds like you just want an investment manager. So off you go. Here's 3 investment managers that you can call. The truth for most clients, particularly when you're in a financial planning centric and oriented relationship in the first place, where they want to hire you and they want to delegate to you. Funny thing about delegators who delegate portfolios to you, they don't tend to ask a lot of questions. That's why they delegated it to you, because they don't want to worry about that crap. They want you to worry about it so they can get on with their lives or their businesses or their careers or whatever it is that they're doing. So I mean, frankly, I find when you really get into it with clients in planning centric relationships, you will very rarely ever hear a question like, why did you buy this and not that? What you will hear are 2 or 3 other questions that kind of sound similar but are different. One is, why did you sell so-and-so? Because what they're actually concerned about is not the investment reasons you sold it, but the fact that they got a tax bill out of it. And just anytime tax liabilities show up, people sometimes ask some questions, but they're not really investment questions. They're tax questions as much as anything else and can be explained in that context. The second kinds of questions you'll get are things like, why don't we own more gold in the portfolio? Which is not actually a question really about explain to me the virtues of asset allocation and why your chief investment officer decided to buy 2.7% in gold instead of 4.1 or whatever numbers they're picking out. They're probably asking you because they just saw an article on Facebook about why gold is going to 3,000 and they're asking about it. Right now I'll probably be like, hey, are you going to buy a Bitcoin ETF in your portfolio for the same thing? They're not really investment questions at the end of the day. They're pop culture questions or their news headline questions. And it's as much about giving context to the news and why, today it's Bitcoin. A few years ago, it was gold. A few years before that, it was real estate. A few years before that, it was oil, because the big thing in the mid 2000s was peak oil, and oil was going to go to $500 a barrel because we were already paying almost $5 a gallon at the pump. And there's always a something out there. that's in the news and sometimes eventually gets translated down to questions about the portfolio, but they're not really investment portfolio questions. They're sort of, explain to me again why I can ignore this thing in the news about so-and-so. And you just have to explain why they can ignore this thing in the news about whatever it is and move on with the portfolio that you've already allocated for them. But the number of questions the number of clients that get nitty gritty about investment questions when they've delegated it to you in the first place is way fewer than you probably expect or anticipate or fear. And the ones who are that investment intensive, A, just may not be great fits for you, and B, you probably will have that tipped off by the very first or second meeting with them. So it's not going to be a surprise.
Yeah, don't be afraid to say no. That's what we're getting at. All right, so switching gears just a little bit. Why would you use a TAMP when you as an advisor should have the education, credentials, and resources to build a well-diversified, low-cost, tax-efficient portfolio for a client? You are either costing yourself or your client a lot of money. This is a very fair question because, again, this is sort of where our industry came from, right? Like planning came out of investment management. It's where we started. Even the CFP education is still very investment centric. We still learn a lot about how to manage investments. So why can't we just do this ourselves? And the truth is, some of us just prefer, I think, two routes. One, you either may not know it, which we can talk about what that means and whether or not you should manage investments if you just don't know it or aren't comfortable with it. And then the second reason is time. Right. So let's start with the first one around, whether or not you know it. I mean, was it fair for me to manage my client's money, even though I honestly did not know how to open up an account at a custodian or actually have rebalancing software? Is it fair? Is it fair for me to charge for that? Or am I doing my clients a disservice and really I shouldn't even do it at all?
Well, I do think it's a fair point that if you're going to do and charge on it, you do need to add some value at some point along the spectrum. I mean, it is a fair issue of you don't just kind of extract economic rents in the econ talk. Like don't just extract some dollars out of your client's portfolio to purely do nothing but just kind of go along for the ride. But the reality is there's more value that we add in this equation that I think sometimes we give it credit for. And to me, the quintessential example is things like, why would I charge 1% or whatever it is when clients can just get a similar portfolio from Vanguard or Schwab or Betterment or Wealthfront or any number of other robo-advisors? And the answer is because without you, the client actually has to figure out, are you going to put your money with Vanguard or Schwab or Betterment or Wealthfront or any number of other robo-advisors? So how many clients are really good at doing due diligence on 4 different third-party money managers that they're going to use for themselves if they go direct? How effective are they at making the investment comparisons? How effective are they at going through the decision-making process? Are they certain that they're diligent about doing all of the evaluation that they should be doing and finding all the potential hidden fees or costs or distorted investment allocations or whatever may or may not be there? Not that any of the companies I just mentioned do particularly bad things, but there could be a 5th one they're evaluating that is full of crap. And it kind of looks like a nice website, but it's actually terrible investments that underlie it that are expensive and overpriced and all the fees are hidden. As a consumer, figuring that stuff out and trying to sort out which one is best and going through the stress and taking the time and going through the due diligence, or just hiring an advisor you trust to do that and figure that stuff out for you, that is really valuable. That has really material value for you. I mean, even from the regulator perspective, like truly, getting paid to do supervision and ongoing oversight of portfolios and even third-party managers has frankly been recognized since the Investment Advisors Act was originated in 1940 as a valid and relevant service that investment advisors provide. So it's not just about being the hands-on person that actually trades every stock and bond granularly, there's value even when it just comes down to the selection of managers, the selection of platforms. I think sometimes we get so wrapped up in our heads about, geez, after I've been doing this for 12 years, making diversified portfolios just really isn't that hard. Okay, bully for you, but for the average consumer who spent less than 12 hours in their lifetime ever thinking about this, it's freaking terrifying for a lot of them. And saying, wait, for like just 1%, you can make all this fear and pain and discomfort and nervousness go away and just get a thing that actually will be good because I know you're good at picking managers and you'll just save me from 47 terrible managers out there. That's really valuable, even if you're not spending the time doing the investment analysis and picking the stocks and bonds one at a time. Don't underestimate the value of being someone that does the due diligence on third-party managers and helps clients figure out what's good and what's not.
Yeah, and I think that's what's difficult is because, clients don't pay us because we're the most efficient rebalancer, advisor at rebalancing, or the most efficient at opening accounts, or so much of the work that TAMPs actually do, which I think is totally appropriate to outsource. But when it does come down to it, I'm not sure that they're paying for that side of the equation, even, down to the due diligence and that sort of thing. Obviously we're giving oversight and being sure they're implementing. But that's really what it comes down to is they're paying for implementation and integration of the investment management into their financial plan. And, it is 1/7 or 1/9, depending on how many of services that you do. Let's call it 1/7 of what you do for your clients is investment management. And having help there, I don't think is a bad thing. Now, to your point, you do need to have an understanding of what's going on. And I was overstating my uninvolvement just to make a point. I actually did know what was going on. I just didn't know how to open an account, but I did learn. So, which is, one of those things that it's a funny thing that you have to figure out one of those days.
Yeah. But it is important to understand, again, just we underestimate the power of our own expertise and how easy some of this stuff gets for us when we've been doing it for a while, and how not easy it necessarily is for clients to do it themselves, right down to even if there are a bunch of providers out there that can do this relatively easily for them directly, they have to figure out which one is good and which one is not. And for all of you listening to this, who have ever sat across from a client whose former advisor screwed them horribly, and you're sitting there going, how on earth did you even get suckered into doing business with this person? Welcome to why it's so valuable to just help them get to a good, straightforward solution, because not everybody can actually figure this out on their own. It is a real value we bring to the table, particularly in a world where once you're working with, we'll call them smaller clients with more modest account balances. There's all this discussion out there of the median advisory fee is about 1%. So, why would I charge 1% to my young professional client when I'm just going to outsource the money anyways? So the first thing just to remember in that statistic, the median advisory fee is about 1% on $1 million account. When you shift a little and you say, well, what's the median advisory fee on an account that's less than $250,000? Bob Veras did some great research on this last year, just surveying I think it was 1,000 advisors about their fees. The median all-in fee, including the advisory fee and the underlying costs for accounts less than $250,000, 1.85%. Median. So 50% are higher than 1.85 all in. So if you're going to go, use an investment TAMP platform that charges you 25 or 35 basis points, and then you're going to charge your 0.6 or 0.7 or heck, even 1. And then you layer going rate these days, like 5 or 10 or 15 basis point ETF and fund fees on top for some index funds, you are still drastically cheaper than the median fee for small accounts. I think at some point we we slipped our perspective, that we started talking about this median fee, that the typical advisor charges 1%, and completely missed the fact that virtually all advisors use graduated fee schedules, and that it's not one as a typical fee on small accounts. And even a lot of the folks that talk about the one, that's one before all the underlying costs of funds and the rest, which often adds a non-trivial layer, particularly in some financial firms or in some broker-dealer channels where they don't even get access to the lowest cost funds because the broker-dealer makes them use the ones that have the 12B1 fees, because even if the broker doesn't get the 12B1 fee, the firm takes the 12B1 fee and the sub-TA fees and a whole bunch of other back-end revenue sharing agreements that often happen in those environments. So, just again, I think we get so comfortable with our own expertise that we start to grossly underestimate how valuable this service actually is for clients and how much cheaper you probably are, even when you're stacking 1% on top of a TAMP that uses a bunch of ETFs. You are still cheaper. And not all advisors even stack 1% on top. At least we see that in XYPN. Some do and some charge lower numbers.
Yeah, we're going to dig in a little bit on fees here in a second, but I do think it comes down to, that there should be an assumption of delegation, not abdication, whenever it comes to using a TAMP. This is not a, here it is and then walking away from it, because ultimately you're still responsible for monitoring and knowing what the TAMP is doing.
Literally, if you're an RIA, an advisor, and a fiduciary getting paid on the account, like, you do have to be doing some monitoring and due diligence on your sub-advisor, your TAMP, the asset manager that you have delegated to. It's very true. Like, it is delegation, not abdication, both from a value perspective and from a regulatory perspective, as far as the SEC and state securities regulators are concerned, with the caveat that doing effective due diligence on a third-party asset manager is a little bit easier than like managing every single investment yourself. So that this could still be a good use of your time.
So I started off this question by saying sort of you can go two routes. You can go why aren't you, that you may outsource because it's not an area that you're comfortable. But I think the second reason that a lot of folks outsource is just when it comes down to money and time. So when you are starting a business and you're getting started and you have 20, 30 clients, you're out there doing business development, you're designing your planning process, you're refining the business, the last thing that you need to be doing outside of your own bookkeeping is opening your own accounts and doing the trading and the rebalancing and the due diligence. And when a custodian comes out and blows up your models because they make a change to the trading fees, suddenly you have to go back to the drawing board and spend a couple of days rebuilding models.
The number of advisors I know that lost like 2 to 4 business days of productivity last November when TD Ameritrade blew up all the ETFs in their ETF market center and yanked out all the Vanguard and most of the iShares funds and put all the Spider funds in. 2 to 4 business days because a custodian changed a lineup that each one of those advisors had to do for themselves to do all their fresh investment research and due diligence. That's days of not meeting with clients, not meeting with prospects, not having a vacation, not doing whatever else you could have been doing, because when you keep all of that responsibility, you keep all of that responsibility.
And guess what? It's going to happen again. And then it's going to happen again, because it quite frankly, it's not even that major of a thing to happen that could cause you to go back to the drawing board and again, lose several days rebuilding your models. But when I look at this, just to do some quick math. So XYIS, the first break point, it starts at 35 basis points and it goes to 30 basis points at 5 million. So let's just assume you're the one paying the TAMP fee, which again, we're going to talk about here in a second. On 5 million, 30 basis points, that's $15,000. So you are paying $15,000 to the TAMP to do what it does. And so my question is, if you do not have to go buy a performance reporter, if you do not have to go buy, let's just say that put in the time that it takes to manage the relationship with a custodian and with the various fund companies, to do all the due diligence and model building, to build the resources for selling sort of your investment management service and having those marketing and sales materials. If you don't think there's value in having a CFA or multiple CFAs that quite frankly, actually know how to track whether or not an ETF is mimicking the performance of the index it's supposed to be, and whether or not a change needs to be made. All of those various pieces, basically, if you want to go out and just get a performance report and hire a CFA, you're out $150,000. This is 90% cheaper than that. If you have $1 billion under management or like $100 million under management, I get it. Okay, from a cost perspective, it may make more sense to in-source this. But really, when we've run the numbers to say, at what point can you truly in-source the service model that a TAMP can scale? $100 million is around the break-even point. That's around where you're spending enough money that, it makes sense to bring it back in-house. So, especially for a startup or a scaling firm that's growing quickly, this just doesn't contribute to your growing and building the business, and spending that $15,000. One will save you a ton just in terms of direct costs, but it'll save you a ton of time and headache and just overall saving your energy for what matters, which is going out and getting clients.
And again, just to note, that number that you're throwing out, $15,000, like that's the basis point fee on a bunch of assets that are there, which means you're also billing your own revenue that's going to be a lot more than $15,000. The other virtue just from TAMPs in general, and it's just a basic principle of business, managing expenses with variable cost, especially in the early stages, is really nice. You know how much you pay a TAMP before you have any clients? Zero. You know how much you pay your staff member if you have to have a staff member before you have clients? A whole lot of money, because they want their salary regardless of whether you're bringing any revenue yet. And it gets even harder when you start growing and you say, all right, well, I've been doing this for a year or two and I've got some revenue going. I really need like just a half-time staff member because I don't have enough revenue for a full-time, but I don't have enough time to do all the work myself. It's really hard finding really good part-time people who will stick with you for a while. It's not so hard to find a TAMP that just scales perfectly with whatever your needs are because you're paying basis points, and the more assets and clients you have, the more that you pay them, and the fewer assets and clients you have, the less you pay them. There's a lot of power to just managing your staffing and resource needs with a variable cost. And the biggest challenge that I think most advisors get into is just when you're first getting started, you have a lot of time and not a lot of clients. And so it's really easy to say like, oh, I can do all this stuff. I can do the portfolios and I'll do the investment research and design and I'll trade them and I'll manage them and I'll set up the models and I'll do all the stuff. It's easy to say that when you don't have very many clients yet. You have a lot of time. Eventually, after a couple months or a year or two, you're going to have a lot more clients and a lot less time. And you will probably find that you regret this decision. And that's the biggest blocking point that I actually end up seeing for a lot of advisors that go through this. They underestimate the value of their time right when they're getting started because they don't realize how quickly their time is going to fill up as their business starts growing. And the truth, if you really want to grow a business, you will forever and always be hiring staff, rotating duties off of your plate, and evolving your own role. I mean, if you really want to build a bigger business, that's what happens, and that's how it happens. And so to say, I want to keep all this stuff internally when you can't possibly sustain that in the long run as your business grows, ultimately means no matter what, you will have to let this go. So either you will give it to a TAMP or you will hire staff because you can't do it all yourself. So just have a plan for what you're going to do and whether you're going to hire up staff or whether you're going to outsource. And if you start running your business plan, you will probably discover employees who want salary and benefits and a stable job and training and all the rest that you have to do when you hire and develop and manage them yourself is not necessarily a stress point you want, particularly on the investment side. It's one thing if you're going deeper on planning and you want to hire your paraplanner who eventually will become a full planner and take over your clients. But do you really want to go hire a CFA and a lead trader that you're going to otherwise have to do at some point if you keep growing?
Yeah, that's a great point. All right, moving on to the next question. How do you position using a TAMP to your clients? Is it seen as a positive or a negative? Do you have any tips for talking to my clients about me using a TAMP? This was something I obviously had to deal with, and I will say that I never once got a question from a financial planning focused relationship around what was going to happen if I died as a solo. Now I'm speaking from a single advisor with no staff. No one ever said like, well, what's going to happen to my financial plan if you're no longer here? But I got a lot of questions about where their money was going to be if I was no longer available. And that was really one. I mean, there's obviously a lot of different selling features of a TAMP when you're communicating it to your client. But the way I positioned it was, look, I am here by myself. I want to stay small. I want to maintain the relationship with my clients. And I don't want to have to hire 3 people to handle my investments. So I'm going to bring in, this outside company. I used to refer to them as the investment gurus behind the door. Like I had a door in my office. No one knew what was behind it. It was just another room that wasn't mine. But I said, just imagine that my TAMP that I've, contracted with is just an investment guy on the other side of the door, which wouldn't bother you one bit. You'd be, fine that I have an investment guru on staff. Basically, I just have that. They just don't actually work behind the door, but they're providing support in all of these areas. And, they're going to be here if I'm not. So if there's a problem, if I'm on vacation or not available or get sick or heaven forbid, die, they're there. They're available. They'll pick up the phone when you call them. Your money is safe. And the second thing is, I can't be an expert in all things. And it's sort of back to our earlier point, like I don't want to try to be the expert in investments. They're the expert on the investments. It's what they love to do. The last thing they want to do is talk about financial planning with a client. The last thing that, an investment guru wants is someone crying in their office, right? That's my job. And I'd rather them do their job and me do mine. And so I obviously, whenever you're pitching it to a client, like I always sold it as a major positive. And quite frankly, I never got any pushback. Like I just, and maybe it's just sort of my personality, but I just sort of always had this presumption of they're here, they trust me as their advisor, and I'm telling them that I think this is best. Like I'm not trying to talk them into it. I'm telling them what I think is best. And if that doesn't work for them, quite frankly, it's probably, probably the wrong relationship with the client.
It's funny. For Pinnacle Advisory Group, we also have a TAMP platform. We've had it for many years. So we do our investment process internally for our own advisors, and then we serve as an outsourced investment manager for other advisors as well. And so I've watched these kind of conversations and dynamics firsthand for many years about how advisors handle this relationship. And honestly, I've seen it go both ways, and I've seen both work fine. So some advisors will come to the table and say, you're hiring me, Smith Financial. I'm going to be handling your investments. I'll be monitoring and overseeing them. I have a team that supports me, parentheses, they're external managers. Right? They just sort of say, look, I'm Joe Smith at Smith Financial. We're going to manage and oversee your assets. We'll handle it. And the reality is, if I go into Joe Smith's office, I look around, I'm not going to find any other employees there because the money's all being managed by a third-party manager like Pinnacle. But, the client experience is I'm with Smith Financial and Smith oversees my money. Other advisors come at it from very much the perspective that you just articulated, Alan, which is they're quite straightforward and upfront to say, look, I'm here to be your financial planner. I'm here to work with you to make sure that your investments are managed well. Having done my research and due diligence, I have found Pinnacle Advisor Solutions, and I think they have an excellent investment process that I've evaluated, and they're going to be managing your money, and I'm going to be monitoring and overseeing to make sure that they do a good job. And, they're great at what they do. I'm your financial planner and I do the financial planning work with you. And just that's the deal. And it's set up for the client from the start. I'm your financial planner. They're going to manage the money. I am monitoring and overseeing them because I've selected them and brought them to the table. And that's the way that it's presented. And honestly, both work fine. I think just from a value proposition perspective, if you are a planning-centric advisor and you're trying to put forth that your primary value is the planning, I would tilt towards just saying, look, I'm your planner and we've selected a third party manager to work with us. And here's the third party manager. I mean, I think I would tend to do it with the kind of the separation of powers. I'm your planning guru. They're your investment gurus that I'm bringing to the table for you, as opposed to doing sort of the Smith Financial, we do it all, even though we actually outsource some of it, just from a kind of a positioning and client perspective angle. But, again, when the clients have hired you and delegated these decisions to you, most of them don't care nearly as much as you're afraid that they do. If they did, they would have asked you more questions before they hired you, or they wouldn't hire you in the first place, or they would have gone to some other advisor that just talks investment stuff because that's what they were really looking for if they really wanted an investment-centric relationship. If you're focused on doing the financial planning, and that financial planning, ideally, whatever your niche is your value proposition, and this is just part of the services and solutions that you bring to the table, you may be surprised or occasionally even depressed and dismayed at how little a lot of your clients are actually going to ask about this or push back at all. They trust you. That's why they work with you. When you say, this is the solution I'm implementing to make sure that your investments are managed well, most of them are just going to say, yes, that's great. And thank God I don't have to go online and figure that out for myself.
So true. All right. So the final question, which is really what spawned this entire episode, and one that you and I actually, I think in some ways disagree on. So this should be fun. I'd love to know your feelings on how many advisors are breaking out the TAMP fee in terms of billing, both in terms of transparency and business practice. So this advisor gives 4 scenarios, basically trying to keep the numbers even here. So advisor charges 1% to their client, and then out of that 1%, they pay the TAMP fee, let's say of 30 basis points, but the client doesn't know that. All the client sees is 1%. That's scenario 1. Scenario 2, the client pays a total of 1%, but they pay 2 fees. They pay 0.7 to the advisor, 0.3 to the TAMP. So it's split out. It's still the same amount of money to the client, but it is split. Or the client pays 1.3% now because I want to keep my 1%. So therefore, I'm going to charge my client 1.3 and I'm going to pay the TAMP their 30 basis points, but the client doesn't see it on their bill. All they see is the 1.3 total. Or they're going to see 1% go to the advisor and 30 basis points go to the TAMP. So it's still that same total of 1.3%. However, it's split out. So a lot of advisors are wrestling with, how do I handle this? I've been charging, 90 basis points, or I've been charging 1%. And now all of a sudden I'm going to be signing up with a TAMP that charges 30 basis points. Do I add it to their bill? Do I include it in my fee? Do I split it out? And you have pretty strong opinions on this. So I'm going to let you run with this one for the start.
So to me, there's really 2 different issues that go along that go into this. I mean, one is basically to what extent do you itemize and separate out the fee, and the second is, what should you charge overall, particularly if you're transitioning from not having done this not having used a TAMP in the past to suddenly using one. So let me start actually with the second one first. So this whole, I used to charge my clients 1% and I was doing it all myself. Now I'm introducing a TAMP. It costs 0.3. Basically, I think the real question is, do I start charging my clients more? Do I mark them up to the 1.3? So first and foremost, it's really important to recognize here, there's a huge distinction just out of the gate between what are you going to do with your existing clients and what are you going to do with every single client you work with from this day forward. Because guess what? Every single client you're going to work with from this day forward has no freaking clue that at some point in the distant past, you used to do it all internally and charge 1. All they're going to see is you charge 1.3. And it's 1% to you for what you do, and it's 0.3% to the TAMP to what you do for what they do, which frankly, if you want to pull out the average cost of a mutual fund, you will probably find that the TAMP looks like a pretty good deal, even when your 1% fee is stacked on top. So, frankly, my default on this around just, are you charging the 1, or are you charging the the 1.3 is, I think it's fine to charge the 1.3. Again, the median fee for a small client all in is about 1.85. You're going to be at 1.3 if you're, literally doing this as an XYPN member and you're asking about this for in the context of XYIS. The underlying ETFs are going to add a minuscule number of basis points. Our core NTF portfolio is mostly spider ETFs that are like 3 to 5 basis points. I think a few of them are like 7. So, you're still going to be 30 or 40 or 50 basis points cheaper than the median fee for clients under $250,000. And if you're concerned about it for your $1 million clients, sure, go ahead and add some graduated breakpoints for your fee schedule. Lots of firms do. So like the core point here is, if you're that anxious about it, you may be focusing a little bit too much on this perception issue of the difference between 1 and 1.3, when every new client you work with is never going to know that there was a change because they weren't there in the first place. For the subset of clients you've got where this actually is a change, there it gets a little bit more nuanced. But honestly, it's not that challenging to go to them and say, hey, great news. I've been managing your portfolios directly hands-on. I have found a third-party manager that can help do an even better job going forward. And, they're a little bit more expensive, but I think the value is worthwhile for what you're going to get out of it. And here's the new structure. And just tell them what it is. And, we see this all the time at Pinnacle Advisor Solutions when we watch advisors transition to our TAMP there. The single scariest conversation that we see for most advisors is going to their existing clients and telling them about how the fee structure may be different or a little bit higher now that they're outsourcing, not doing it all themselves. And they're terrified of the conversation, and they sit with their client and tell them, and the client says, well, do you really think that's best? And the advisor says yes. And that's the end of the conversation. Because they trust you, because you already have their life savings.
Yeah, you make a great point that we tend to want to do the same thing for all of our clients and not have sort of this differentiation between, some of my clients are paying one fee and some of my clients are paying another. And depending on where you are in your business may dictate how much of that you can do if you have 10 clients versus 100 clients and you're sort of full, how you want to handle this. But, I personally just always included the fee when I quoted and I guess trying to think of the best way of framing this. I think it sort of encompasses both the transparency of the fee as well as just sort of how much you're charging. I always just quoted a single fee because it was confusing to me to quote two different fees on, you're going to pay me 1% in addition to your financial planning fee, but you're going to pay this other person 30 basis points. And guess what? Clients don't know what a basis point is. They can't do basis point math. I can't do basis points math. So, I would just say it's 1% or it's 1.2%, and that's going to just be all in. I'd rather just give an all in fee. Now, I never included ETF fees or mutual fund fees because, quite frankly, that is just an expense ratio for and a fair fee for, the services that they're providing. We're seeing it go down over time. So I'm not too hung up on, let's be sure it's 1.37 because I have 7 bips to the ETFs. One, I would just quote one fee. Now, what you quote and what comes through on the statement can be different. I'm personally indifferent to if the fee gets deducted separately or as part of the advisory fee. Like, I just don't think to me, it doesn't really matter. I guess at that point, the client knows what they're paying for the TAMP. However, there's also an argument to be made for, let's not separate it because we don't want to we don't want to put that specific of a value on the two different services. But again, just don't know of advisors that are having issues with their clients. I think this is asking questions about that. I think this is very heavily what if they ask me, what will I say? And then they never ask.
I do think it's a fear that we tend to work up much more in our heads than what actually happens and comes from clients at the end of the day. And look, to each their own about just where they want to set their fees overall. I'm certainly not going to beat anyone up who says, look, I'm outsourcing my investment management. I think that means it's going to take me less time and work to do it. So, I'm going to keep the fee 1% all in, and I'm just going to dial mine down to 0.7 now that I'm paying 0.3 to a TAMP. I don't think there's anything wrong with that either. The point here, though, is just we get so wrapped up in the last couple of basis points of costs. And I don't want to diminish costs and the importance of cost and managing costs to clients. But, if you were worth 1% to pick the investments, you're still worth 1% to pick the investment manager. It's the same responsibility. It's the same authority that the client is delegating you to make investment decisions and to figure out where their money should go. And you don't have to discount your value because you've decided the best path forward is not to buy some stocks or buy some ETFs or buy some mutual funds. It's to select a manager that will do some of those things for you instead. It's not a diminishment of your value. I don't know any advisors out there who come forward and say, well, I normally charge 1%, but I'm going to discount my fee by the expense ratio of all the mutual funds that I use. Even though at the end of the day, the only difference between a TAMP and a mutual fund is just how the wrapper works. Both of them are third-party managers that make all the individual trading decisions and activity to whom you have outsourced, and they charge a management fee. Granted, the TAMP version is a little bit more transparent because mutual fund expense ratios just kind of get subtracted from the fund. But if you weren't subtracting your mutual fund fees out of your advisory fee, I don't know why you're subtracting a TAMP fee out of it either. The service of picking managers is still a service that is not that different from all the other investment stuff that you were already doing. So just don't be afraid to charge your value for what it is. Now, in terms of kind of bundling fees versus separating, honestly, I go back and forth on this a little. I mean, I think from the client's perspective, I think it's a lot simpler to just either quote an all-in fee or at least start with an all-in fee. You can itemize out and explain to them what the components are because it's just good for transparency. But I wouldn't come at this saying, well, I charge 1% and then this TAMP is going to charge another 0.3% on top. And then you're going to buy some ETFs on top of that are going to have a whole bunch or a little bit of additional expenses. And then when you add them all up, it's going to be so-and-so. You just start the conversation that way. I mean, you're making it sound like you're layering a whole bunch of fees on them. Even if they don't care, you're going to make them care if you kind of build it up that way. So I think it's much cleaner to just come to them and say, look, we charge a total investment management fee of 1.3%. A portion of that goes to a third-party manager that we use that helps to do the individual stock picking and fund picking. We charge an advisory fee of 1% as well. That's our share for doing the due diligence, the monitoring, the selection, the evaluation of the investment manager in the first place. And you know what? You're going to be paying me my 1% fee because if that TAMP doesn't do a good job, you and me are going to fire them. And we're going to go find someone else. And it'll be my job to find you the next investment solution provider if the one that we're using doesn't work out for you. And so that's the value. And so quoting it all in, I think, helps just simplify that conversation from the start. And then you can kind of itemize it out a little to explain who does what and who pays what and why.
Now, this becomes increasingly important for advisors that are charging investment management fees on a non-AUM basis. So when we talk about, 1%, we're going to add it, we're going to subtract it. It's easier conversation. Where it gets really complicated is I charge my clients $5,000 a year all in for financial planning and investment management. Or I charge a net worth and income where AUM simply doesn't scale, as fast, or some other fee structure that's not strictly AUM. And we hear this all the time because folks will say, well, does XYS have a maximum per account or household fee, no more than $1,000 per client or something like that, because their fee caps at a certain level. So therefore, it would be very painful and quite frankly, impossible for someone to commit to an AUM TAMP fee if they are not charging on AUM. And so this comes up where, and I get it, right? If you charge $5,000 a year, you're not going to pay 35 basis points because at some point that is going to hurt and suddenly you will be losing money. And our contention has been, that's fine. Just let the client pay the TAMP fee at that point. If you're set, and we can argue about the what is the right service model and fee structure and all of that. But if that is your fee structure that works for your ideal client profile, because, for whatever reason, that's the right fee structure, just let them pay the TAMP fee separately from the planning fee that they're paying you.
Well, that's the virtue of coming at this and saying, like, look, here's what I charge for what I do, and here's what the TAMP charges for what they do. You don't have to subtract the TAMP fee from your fee. You don't subtract ETF expense ratios from your fee, even though you could ditch the ETF and just buy every single one of those stocks one at a time, use a fancy rebalancing software. You could blow out the entire ETF if you wanted and just buy all the individual stocks. But at some point, you probably figured out it's a lot easier to just do one ETF trade than it is to do 500 individual stock trades, but you're not subtracting the ETF expense ratio out of your advisory fee. If you use some mutual funds, maybe you think there are some managers out there that do add some value. I don't know a single advisor that subtracts the mutual fund fee out of their advisory fee. So I don't know why we're so obsessed about subtracting a TAMP fee out of our advisory fee. I mean, even just across the board, or especially when you get advisors that as financial planners, we advise on a wider range of things. I mean, if you want to sort of extend the analogy, like we don't pay ETF expense ratios and mutual fund fees out of our advisory fees. I tell all my clients to prepare their taxes. I don't pay their CPA's bill. I tell them to all get estate plans. I don't pay their lawyer fees to draft their wills and trusts. I get paid for what I do. The endpoint implementer gets paid for whatever they do, whether it's a lawyer preparing a will or a CPA preparing a tax return or a mutual fund manager or a TAMP manager managing a portfolio of assets. And you get paid your planning and advisory fees for what you do, whether that's standalone planning fees or advisory fees or some blend of the two, however you've decided to constitute your fees to make sure that the total dollars the clients pay adds up to the value that you're providing. You don't need to literally pay a TAMP fee out of your fee any more than you don't pay any of those other endpoint costs that clients pay out of your planning fees. Clients pay you for the planning work that you do. You're allowed to, earn that money and keep that money, and let the clients pay for the TAMP service the same way that they pay for mutual fund expenses and ETF expenses and CPAs and lawyers and every other professional that may be involved in their lives. Like it's not double dipping. You're getting paid for the value that you provide, and the other folks are getting paid for the value that they provide. And it's not even unique to TAMPs. We do this across the board. I think we just somehow get particularly caught up in the TAMP part, I think because we get so anxious about these costs that at the end of the day is either something that is not nearly the big deal that we make it out to be, or because at the end of the day, what it really comes down to is we're still not confident enough in our own value to just charge what we're worth. And so we're trying to discount our own fees because of that confidence issue, not because you're not providing the value.
Yeah, to the point that I made earlier, I do think that investment management gets pulled in because, one, it's sort of where we came from, but also to your point, it's the value that we're really good at selling. We know how to sell the value of investments. Look what all we do for you, and we do all these things, so therefore you should keep paying our fees. And, the ability to sell financial planning is obviously a very different skill set and just a different process than selling investment management. Because, in my opinion, so much of investment management is selling what you do. And so much of financial planning is selling that the client needs to do nothing when nothing is the right answer. It's just one of the big transitions. And that shouldn't be taken lightly. The moving our brains from selling, investment management to selling financial planning, it's a really big hurdle. But I think you're right that this gets pulled in because it's just easier to sell investment management. And if we just take a step back and say, okay, I am confident in my planning fees and I'm charging my clients $5,000 a year because I'm worth it, because I'm providing tens of thousands of dollars a year of value to the client. And then the investment management piece, they want to do it under my root or with me because they trust me and I can incorporate it into their financial plan, unlike what anybody else is going to be able to do. If it's completely separate, it's not going to be integrated, and just let that go and let them pay that fee. And, quite frankly, to the points we've been making, TAMPs are getting cheaper. We've obviously priced ours as aggressively as we can. It's just not, it shouldn't be a big hurdle.
Yeah. I mean, even in the TAMP marketplace, like most TAMPs out there are still charging 50 to 75 basis points. Like it's, in the context of, I know some of these conversations we've been having with XYPN members that are just kind of getting up to speed on this. Like XYIS is half the cost of a lot of other TAMPs and working with smaller accounts. Most other TAMPs would charge you more for smaller accounts. Like and again, the advisors using those platforms, they're charging their 1% on top of the 0.6 or 0.7 for the TAMP. That's how we get to those all-in costs in the advisor survey of 1.85 for under 250K accounts. Like, I think we've gotten so stuck in thinking the typical advisory fee is lower than it actually is, and then underweighting or discounting our own value in the process because we're such experts and so comfortable with all this stuff that we forget how stressful it actually is for clients to have to figure this out on their own. Even when it comes down to, yeah, great, there's robo advisors online that'll do this for less. How much time and effort and stress does it cost you to figure out which one to use?
Well, and, Rocket Lawyer and LegalZoom's a lot cheaper than an attorney, but I still gladly pay my attorney. It's not always you get what you pay for, but there is a line at which you've gone too low. I'm glad we were able to sort of pull this together because and I know there's probably this entire conversation is going to generate another round of questions, which maybe we can do another episode on it. Just because I know there's
queue them up in the VIP group, and we'll do round 2 on this conversation again next month.
Absolutely, because this is a topic that I think will continue to evolve, and everyone's coming at it from a different place. If you used to be at a broker dealer versus you were in a small RIA and never touched investments like I was, I mean. Talking about two polar opposites in terms of sort of the world you're coming into if you're starting your own RIA and looking at managing investments. Yeah, if you have more questions that you want us to answer on the podcast, go to xyplanningnetwork.com/VIP. Join the VIP group. We have almost 1,500 advisors in the VIP group now, which is really exciting. So it continues to grow.
1,500 now. No wonder I get a steady stream of notifications all day on new messages from our VIP group. All right.
Yeah, I was just pointing. Okay, 1,437. I apologize for overselling.
Truth in advertising.
Over 1,400. There we go. Advisors that are in there that are hanging out, and it's a very, very active group. So if you're not in, you'll hear it in the intro and the outro, but go ahead and go check that out. But definitely drop your questions in there. Michael, thank you so much for taking the kind of time to come on the show and chat with me about, various questions dealing with TAMPs. I appreciate it. Let Ruby help you turn rings into relationships. For a special offer, visit callruby.com/XYPN and use promo code XYPN or call 1-844-853-7829. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitces, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.